Forget the noise, the hype cycles, and the endless parade of coins chasing retail exit liquidity. Stellar's XLM just flashed a setup so clean, it's practically begging to be front-run by institutions. This isn't just another hopium-fueled pump prediction. This is a cold, technical formation that seasoned traders recognize immediately. An inverse head and shoulders on higher timeframes. And it's not subtle, it's decisive, with a 30% upside target baked in and almost no one paying attention. Zoom out. What you'll see isn't just bullish structure, it's volatility compression at the neckline, signaling a violent breakout is imminent. Each shoulder was printed at incrementally higher lows, which means supply is drying up while demand is quietly stepping in. This isn't retail movement, it's accumulation in disguise. And then there's the confluence. $0.29. It's not just any level. This zone has acted as resistance, support, and a psychological pivot multiple times over the past 2 years. Now, for the first time since early 2024, XLM is grinding up into it with actual momentum and historical weight behind it. If price breaches and retests it cleanly, that opens the runway straight toward 39 cents. A target that once seemed ambitious but now looks like statistical inevitability. You won't see this on mainstream crypto channels. Most are still focused on the daily meme coin pump and dump drama. But here, we track what the smart money watches: early signals, macro structure, and repeatable setups. Before we break down why this setup matters and how the 2021 rally had eerily similar technical DNA, make sure you're subscribed to Be Crypto Smart. Because while everyone else posts moon emojis after a coin pumps, we decode the breakout before it moves. Let's break it down. This isn't some speculative drawing with hopium lines. This is a real textbook reversal signal. And Stellar just nailed it. We're talking about the inverse head and shoulders pattern, one of the most statistically reliable reversal formations in all of technical analysis. When this shows up cleanly on a mid to high time frame chart, it's a signal that serious traders don't ignore. And right now, XLM just painted one with laser precision. Let's break it down frame by frame. The left shoulder? That was February's sell-off. A controlled descent that touched support around 27 cents, bouncing before real capitulation. The head? That came in March, a deeper dip that wicked just above 20 cents. A level that historically acts as XLM's do not cross zone. Buyers stepped in fast. The right shoulder? That formed all through April, as price compressed and bounced once again off the 27 cents region, showing strength at higher lows. What does that tell us? Sellers are running out of ammo. Each new low has been bought up faster with smaller pullbacks. That's smart money behavior. Quiet accumulation while sentiment is asleep. Now here's where it gets critical. The neckline. This isn't just a visual guide. The neckline, hovering around 29 cents, aligns perfectly with a historical confluence zone. It's acted as resistance, support, and a breakout level multiple times over the past 24 months. In crypto terms, that's a lifetime. Every time XLM has convincingly cleared this level with volume, explosive follow-through has followed. And the numbers? They don't lie. The technical projection of this inverse HNS pattern puts the next target at around 39 cents, a 30% move from breakout. Not a meme coin moonshot, a measured move backed by chart structure and historical price behavior. Here's what makes this setup even more lethal: the stealth factor. While most traders are glued to meme tokens and AI hype plays, almost no one is watching XLM right now. This pattern is playing out in silence. There's no FOMO. No major influencers hyping it. And that's exactly what the smart money wants: undervalued, underhyped setups with clear upside risk-reward. And don't forget, this isn't just a pattern. It's a psychological battleground. 29 cents is where retail gets unsure and whales get active. This level decides whether we stay in sideways purgatory or break into the next bullish phase. We'll get into the historical mirror of this pattern in the next section. But for now, know this: XLM's current structure is not random. It's methodical, it's technical, and it's statistically loaded in favor of upside if the neckline gives way. This is the pattern everyone missed. But if you're watching now, you're ahead of 90% of the market. Stay locked in. Here's where it starts to get spooky, in the best possible way, because this isn't just a technical pattern forming in a vacuum. Stellar has been here before, and every time it's entered this same 27 to 29 cents zone with momentum, it hasn't just bounced, it's ignited. What we're seeing now isn't new behavior. It's a well-worn roadmap. And if history has anything to say about it, that 39 cents target might just be the beginning. Let's rewind the tape. Back in late 2020, Stellar climbed back into the 27 to 29 cents range after months of sideways chop. At the time, most traders had written XLM off, same as now. But once it pushed cleanly through that zone and reclaimed it with strength, it was game on. XLM didn't just spike. It ground higher for weeks, building real momentum before ripping to 80 cents over the next few months. It wasn't instant gratification. It was organic, staircase-style growth, the kind of move that attracts institutional eyes. Then came 2021, different macro backdrop. Market volatility was off the charts. Bitcoin was swinging wildly, and altcoins were all over the place. Yet even in that environment of fear and confusion, Stellar once again reclaimed 29 cents. And guess what? Same result. Within weeks, price surged to 87 cents, almost a 3x move. No meme coin magic, no news catalyst, just the same structural reclaim followed by a sentiment flip. Now fast forward to today. Stellar is back in the same zone, 27 cents to 29 cents, and it's starting to act like it wants to reclaim it again. This isn't coincidence. This is pattern recognition on a macro scale. And the scary part, for anyone not positioned, is that these zones have consistently front-ran bigger market moves. Think about the current environment. Bitcoin is stuck just under $100,000, consolidating. Ethereum is hovering below key resistance. Altcoins? Lagging but tightening. This is exactly the type of setup where capital rotation happens. Bitcoin moves first, then ETH, then high-beta altcoins with clean structures, and XLM is one of the few large caps flashing a textbook bullish setup right now. And here's the nuance that separates smart money from noise. Volume behavior. In previous rallies, one of the biggest tells was accumulation volume building up before the breakout. That's what we're seeing again. Look at the volume profile forming around 27 to 29 cents. It's not distribution. There's no blow-off top, no retail mania. This is quiet, steady, non-reactive buying. The kind of footprint institutions leave when they're loading positions before a move, not chasing after it. Because let's be real, whales don't FOMO. They accumulate when it's boring, when sentiment is low, when setups look obvious but no one's talking about them. So what's different this time? Honestly, not much. The technical structure is similar. The price zone is the same. The sentiment is even more skeptical than in past cycles, which makes the upside potential even more explosive. But if there's one factor worth highlighting, it's this: liquidity is thinner. Meaning once that neckline breaks, the move could be faster and more violent than in 2020 or 2021. A supply shock in slow motion. And that's the setup everyone's overlooking. This isn't a pump prediction. This is a pattern of behavior that's played out before and is showing signs of repeating again. Stay sharp, because in the next section, we're breaking down why this isn't just a technical story. It's part of a wider shift in Stellar's fundamentals that could extend this rally far beyond 39 cents. Let's get straight to the point. 29 cents isn't just a number on the chart. It's the gatekeeper. And if Stellar kicks that door down, history and math both agree on what comes next. You've probably heard this before. Inverse head and shoulders targets are calculated by measuring the distance from the neckline to the bottom of the head. Sounds textbook, right? Well, here's the real calculation. Neckline at 29 cents. Head at 20 cents. Difference equals 9 cents. Add that to the neckline equals 38 cents to 39 cents target. Boom. That's your 30% rally. But this isn't just about measuring candles. It's about confluence, conviction, and capital rotation. Because what most traders miss is that 29 cents isn't just any neckline. It's sitting at the intersection of multiple high-conviction signals. Volume profile gap. If you look at the VPVR volume profile visible range, you'll see a notable drop-off in traded volume right above 29 cents. That's important, because it means once price pushes above this level, there's less friction, less resistance. Price can glide. Think of it like thin air. Once it's in, it flies. Psychological anchor point. This level has acted as support and resistance for years. We're talking 2020, 2021, and even early 2023. The market remembers. Traders remember. It's a level where emotions have been triggered, and when XLM crosses it again, those who missed past moves will rush in. It becomes self-fulfilling demand. Fibonacci cluster zone. Zoom out. The 38.2% and 50% retracement levels from the previous macro swing align tightly with the 29 cents to 30 cents range. Why does this matter? Because institutional algorithms are often programmed to fire off orders at those exact Fibonacci areas. It's where the smart money starts to test the waters. So yes, the technical breakout matters, but what gives it power is everything orbiting around it. And here's where things get interesting. A reclaim of 29 cents doesn't just break a pattern. It breaks a narrative. Because XLM has been trapped in a downtrend channel since Q4 2024. Every rally attempt has been rejected along the same diagonal resistance. But this time, the breakout would mean that channel is invalidated. And when downtrends break, you often get explosive moves. Why? Shorts get squeezed. Sidelined bulls FOMO back in. Volume spikes. Liquidity gaps get filled. It's like a pressure cooker that's been sealed too long. The longer it compresses under resistance, the more violent the release once it breaks. That's what you call a spring-loaded setup. Think about it. Every retest of 29 cents that doesn't break only tightens the coil. But the moment it does, you're not looking at a slow grind. You're looking at a slingshot. Now zoom out. Combine this with the inverse head and shoulders structure, the historical context we broke down earlier, and the broader market moment we're in. That 30% target to 39 cents isn't hopium. It's probability. And if Stellar follows through the way it has in every past cycle, that could just be the first leg of something much bigger. Buckle up. Next, we'll unpack exactly why this breakout aligns with institutional positioning, and how the quiet activity under the surface might be the strongest bullish signal yet. Resistance stacking, the battle zones at 34 cents, 39 cents, and 47 cents. Let's not pretend it's going to be a straight shot to $1. There are real resistance zones that bulls need to conquer. First major resistance, 34 to 38 cents. This zone was a key support in early 2024 before it broke down in the February retracement. Break that, and we enter the 39 to 47 cents consolidation range. This is where things get interesting. That 47 cents level, it was a major rejection point in late 2021 and again in 2022. It's also where institutional volume dried up during the last rally. So if bulls want to send XLM back to 50 cents and beyond, they'll need to prove themselves here. But here's the bull case. If 29 cents is the ignition, then 34 cents is the acceleration, and 47 cents is the breakout from the midterm trend line entirely. And once that's broken, that opens the door to 70 cents to 80 cents, which isn't moon talk. It's historically backed and technically justified. We're not guessing. We're mapping out exactly where traders are placing stops, where whales are targeting, and where retail FOMO will ignite. This is how breakouts go from technical to viral. What could go wrong? Bull trap or breakout? Let's keep it real. Not every inverse head and shoulders pattern plays out. And the 29 cents zone is a test. If Stellar gets rejected again and closes back under 27 cents, that could turn the pattern into a bull trap and fast. Here's what would signal a fake out. High wicks but low volume on the breakout attempt. Failure to hold above the neckline for more than 72 hours. A Bitcoin pullback dragging altcoins with it. In that case, we could revisit 23 cents or even 20 cents before another serious attempt. That said, market context matters. The broader crypto market is heating up, with capital rotating from majors to quality midcaps. XLM fits that rotation narrative perfectly. And with Stellar's real-world integrations, MoneyGram ramps, Soroban smart contracts, and growing TradFi connections, it's not just a speculative asset anymore. Which means, if this breakout confirms, it's not just a trade, it's a trend shift. Final thoughts, the setup is rare. Don't sleep on it. You don't need a meme to catch a major rally. You just need the right structure in the right market context at the right time. And right now, Stellar's XLM is ticking all three boxes. Historical reclaim zone, bullish reversal pattern, volume building under resistance. We're staring at a potential 30% move that could be just the start of a bigger rotation into underpriced utility assets. So here's the call to action. If you're not subscribed to Be Crypto Smart yet, now's the time. We're not here to chase pumps. We're here to catch the setups before they break. And this one is ticking like a clock. Stellar XLM might just be the quiet altcoin that surprises everyone in the next few weeks. Stay sharp, stay smart, and stay subscribed.